what we're seeing right now, and in our discussion with clients and on future lease negotiation, is most of the corporation we're having conversation with are really trying to figure out what the impact of what we're going through right now is going to have on their real estate occupation. It's probably too early to call, and I think each and every corporation is going to have its own views. The issue that you mentioned about city center versus suburban location are less relevant in the German context because the city are smaller here. We have less problems to get people into city center with public transport. The buildings themselves are smaller. We average building size here is 5-story height, so we can still use the stairs to get to the office. So I think those short-term concerns about the pandemic are, from my perspective, less relevant than the long-term impact of a recession on the market, which then is gonna trigger another change in the nature of the tenant demand. I mean, the work from home, we believe, is here to stay. Our projection is in the next few years, German companies, German employees would work probably 1 or 2 days per week from home, and this is going to have some kind of impact on the demand. But it's not something that is utterly concerning us for the time being. I think it's something that's going to be manageable over time.
If you look to the United States, for example, it's especially commercial real estate really very badly hit. So would you say that the same holds true also for the German market?
So on the investment market itself, as surprising as it might sound, it looks that German property prices are actually still going up. There is so much inflow still of what we called in the past fixed income refugees, people desperately chasing yield, which is still increasing the value of the real estate. And if you look at the recent transactions that have closed in Germany on the office side, retail and hotel being a completely different story. But on the office side, the recent transactions that have closed in Germany have shown prices, and those are transactions which closed after the start of the pandemic, obviously. They have showed almost increase in prices compared to where we were at the end of last year. So far it looks like the direct investment market and like the share price, I mean, our share price has been depressed since the lockdown, but it looked like the direct investment market seems to be at least ignoring for the time being the economic downturn and also the lack of potential lack of demand for office space in the future, and prices are still going up, which I find is kind of surprising, but is actually happening.
So let's, Olivier, just talk some numbers for us at the moment. I mean, what kind of yield are we talking about then in both prime and average rents?
So if you look at yield at which a prime property would trade today in one of the major German centers, you're talking of yield which are around 3%, sometimes sub 3% for long-term government lease. Which is still a significant premium compared to where you can price the German government bond. Of course, real estate is not fixed income. And then if you look at secondary asset, we are in the market right now with some properties, that would trade probably around 4% yield. So those yields are still relatively low compared to where they were still 5 or 6 years ago, and they're still going down as we speak.
On that renegotiation, I mean, are you finding that occupiers are trying to use the current situation as a way of either extending leases or putting some incentives for prices to fall on leases?
Well, in Germany, what we're seeing right now is we have a number of tenants which are asking to extending their existing leases. And that's, we believe, mainly is linked to the fact that they just cannot make decisions for their future location right now. They're still wondering how much space they need and where they're going to need it.